All right, we'll go ahead and get started. This is Chris Berry with Castle Wealth Group, certified financial planner, certified law attorney. And each week we log in and answer any legal, financial, tax questions that have been submitted either ahead of time or we answer them live online. So if you do have a question that you're looking for some guidance on, feel free to put it in the Q&A. Otherwise, we do have one question already submitted, but if you have any other questions, feel free to submit it ahead of time. We'll start with a positive focus, just something positive going on. And for us, we're real excited. The Walk to End Alzheimer's is coming up this year. The walk that we're supporting is in Livingston County. It's going to be this Saturday, October 30th in Howell. If you want some more information on that walk, feel free to just email us, or you can go to alzeldercare.com and I'll put that into the chat. So if you want to donate or join us for the walk, we would love to have you. Alzheimer's is something that's affected my family and near and dear to my heart, and it's affected a lot of our clients' families as well. So let me put that website, alzeldercare.com, into the chat. And you can read my story and also either join the team, show up for the walk, or make a small donation. We're pretty excited since COVID. This is probably the biggest push that we've had in terms of people signing up, as well as monetary donations. So we're pretty excited about that. With that, I will go ahead and get started. Let me share my screen here. A couple buttons. Some buttons over here. And screen should be sharing in a moment here. And again, if you do have a legal, financial, or tax question or something you want some guidance on, feel free to put it in the Q&A. All right. Again, this is just general information. If you want to see how it applies to your situation, feel free to reach out. So the one question we had submitted ahead of time was this. So if we're looking at doing a Roth conversion, what is the best way to pay the tax on the conversion? So let's just kind of take one step back. So when we're talking about Roth conversions, we need to understand that basically every investment falls into one of three categories from a tax perspective. So first we have what we call taxable accounts. Taxable accounts are post-tax accounts, things like checking, savings, brokerage accounts, even like real estate can be taxable as well. The big thing here is the type of tax you're paying is capital gains tax. So you're only paying on the gains. One of the nice things about this is under current law, this was up for potential changes, but this goes to like the beneficiaries and the kids tax-free because they get what's called step-up basis. So not quite tax-free, but it actually can be tax-free. So we call taxable accounts sometimes taxed, depending on how you have things structured. Okay. Then we have tax deferred, or I like to call tax infested, meaning that we haven't paid the tax on this stuff. These are things like your traditional 401ks, IRAs, traditional IRAs, your 457s, 403bs. Okay, these all grow tax deferred. The bad part of it is whenever you take money out and you're forced to take money out at certain times, that's going to be taxed at income tax rate. And we like to call this always taxed. It's just a matter of when and how, right? And then we have the tax-free bucket. So this grows tax-free and you can pass it tax-free to beneficiaries, the next generation kids. And this is things like Roth 401ks and IRAs, cash value life insurance can grow tax-free. 529s, they have to be used for education, and health savings accounts, they have to be used for healthcare. This is always tax-free. So this is tax-free, and it's always tax-free. Okay. So we have sometimes tax-free, always taxed, or actually a better way to put this would be never taxed, and then never taxed again. All right. So the idea behind the Roth conversion, why a lot of people have been talking about this for a while now, two things. One is the amount of debt we have as a country has grown. Just prior to the pandemic, we're at $22 trillion. Now we're at $32 trillion of debt. And the concern is, how are we going to go about paying for the debt? Is the government going to cut spending? Neither side cut spending. Are they going to print more money? Well, inflation is still an issue, no matter what they say. Or are they going to raise taxes? So we think that they have to raise taxes. And in fact, 2019, they kind of passed the stealth tax, the Secure Act, that says when your kids inherit the IRA money and 401k money, anything tax deferred, instead of them being able to stretch out the taxes over their lifetime, they have to pay all the taxes within 10 years. So, the government's trying to figure out ways to drum up money to address the $32 trillion debt. Plus, in 2018, we had the Tax Cuts and Jobs Act that from 2018 to 2025, taxes are artificially lower. So if taxes are lower, the value of these accounts by nature go up because there's less tax. Think of it as a mortgage. You have a mortgage on these accounts that has to be paid. So what a lot of people are looking at doing is engaging in some type of IRA exit strategy, moving money from the tax deferred account to the tax-free account. Now, the only concern is that when you do this, you have to pay the tax. But I would look at paying the tax now at, say, 22 or 24% or 15%, depending on what your tax bracket is, versus 15, 25, 28%, or even much more in the future. So the idea is that the tax deferred accounts, like your traditional IRAs, 401ks, they're always going to be taxed. But I would rather pay the tax now at a lower rate than pay the tax at a higher rate in the future. And so that's why with a lot of our clients, we're stressing this idea of developing some type of IRA exit strategy. How are we going to exit these tax infested accounts in a smart, intelligent manner based on numbers? Because we know taxes are scheduled to go up. Now, they could theoretically extend it, but I don't necessarily see that happening. So plus we're $32 trillion in debt. So the idea is have some type of IRA exit strategy. And this could be things like a Roth conversion or what we call a trust conversion. We can look at cash value life insurance. All of these are forms of IRA exit strategies, getting money out of this tax deferred, tax infested account. So a question comes of, okay, that's great. Let's look at moving the money out, but we got to pay the tax. So where do we want the tax to come from? Really, or how are we going to pay the tax? So really, there's two ways that we can look at doing this. One is, okay, let's say we do a Roth conversion, because that's the simplest for people to understand. They've heard of that. So we do the Roth conversion, okay? And so let's say, just round numbers, we have 100,000 inside of the IRA. Okay. And understand that the best money, like given the taxes are going up, is tax-free money. Like that's the best money. Second best money is taxable money. Third best, or worst is tax deferred. So ideally, I want to get as much as possible into this, the best bucket, which is the tax-free bucket. So if I have a Roth conversion, or if I have $100,000 in my IRA, ideally, I want to move that $100,000 over to the Roth. But if I do that, understand I have to pay a tax of $20,000, okay? And so the best way to pay the tax is if you have cash pulling this money from a taxable account, okay? So pulling the money from like checking savings. So you move 100,000 from the traditional IRA, put it over into the Roth. Now there's 100,000 there. You have a $20,000 tax bill. And if you have the cash, you pay the tax out of the cash, out of the taxable account. to maximize the amount you're getting into the tax-free account. Now that's ideal. I would say 90% of the time we don't do it that way. The reason is we always don't have a lot of cash on hand, especially when we're doing big Roth conversions or big IRA exit strategies. Like over the last couple of years, I've had clients with 2 million, 3 million, 4 million doing IRA exit strategy, and they don't have the cash to pay for that. So the second way, and this is the way that we normally do it, just because the way that people's assets are structured, is that, okay, let's say we do this IRA exit strategy, but this time what we're going to do is we're going to withhold the taxes, okay? So this is a way that if you don't have a lot of cash to do the Roth conversion, it's a strategy. It's a strategy on how to still get his money into that tax-free account and participate in that IRA exit strategy. It's not as ideal, but again, there's sometimes like the ideal best way to do it, and then the real world, this is the hand we're dealt and we play the best cards possible. So in that situation, let's say we still have that $100,000 IRA, but maybe we don't have the cash on hand to pay the tax. So what we could do is say, okay, you know what? I'm going to send $80,000 to the Roth. Okay? And then of that $100,000, what I'm going to do is send $20,000 to the IRS. Okay. So the net effect of this is we haven't touched your cash on hand. So that checking, savings, your emergency fund, we haven't touched that. So if you're cash poor, we can still do the Roth conversion. But now instead of putting 100,000, we're just putting 80,000 into the Roth. The remaining 20 would then go to the IRS. And then when we do this, we don't have to worry about any tax bills at the end of the year because we've already sent the money to the IRS. So this is, while it's not as ideal, this is typically the way that we do it, is we just withhold the taxes. So instead of sending $100,000 from the traditional IRA to the Roth, we send $80,000 from the traditional IRA to the Roth, 80,000 to the Roth, 20,000 would go to the IRS. Some things that we have to be careful for. This really is for people over 59 and a half. Otherwise, they could say that this is a penalty of withdrawing money from a pre-tax account prior to 59 and a half. But I would say 90% of the time, this is the way that we do it. Maybe 10% of the time, this is how we do it. Either way, both are great because both are getting money out of these tax-deferred, tax-infested accounts, getting the money into something that's better, whether it's a tax-free account or even just getting it into a taxable account. That's better than that tax-deferred account. And so when we're doing this, when I say doing it intelligently and smartly, this is where we look at the numbers. We look at the tax brackets, we look at the investable assets, we look at this window that's closing with the Tax Cuts and Jobs Act. We look at other factors like, are we concerned about long-term care in the future? And then every situation is a little bit different. So there's no hard and fast rule. But for a majority of our clients, at the very least right now, we're looking at getting into that 22 or 24% tax bracket. Sometimes if we're really concerned with where taxes are going in the future, we might do it all in 1 year and just rip off the Band-Aid. But to answer the question, those are the two ways that we look at paying the taxes when we're engaging in this IRA exit strategy. So hopefully that was helpful. Do you have another question coming in? Any insight into tax planning for Canadian retirement accounts, which are like IRAs and RMD type rules being at age 72 for US residents and tax filers? We don't do any international stuff. Typically clients will have like a strategy for their US investments, but then you have to talk to someone outside of the country if you're talking about like Canada or India or England. That money is held differently, has different rules, and I'm in no way licensed to talk about out of country issues. So that's where, even from an estate planning perspective, if you have stuff out of the country, typically we recommend like an estate plan for everything here in the US, because that is US assets, US property, it follows US rules. And then if you have money or assets, or I have clients who have like real estate in Canada or have old accounts over in Canada or India or like Germany or England, you need to have a plan for that stuff separately. From a tax perspective, the US always likes money coming in. So if I'm not mistaken, there's no tax to like bring money into the US because they want more money to tax. But yeah, if you have Canadian assets or Canadian property, you're gonna have to talk to someone in Canada about that. All right, that is all I have. So, oh, someone's raising their hands. If you can put your question in the Q&A, just type it out. That would be easier versus me trying to figure out how to allow people to talk. So if you can, oh, here you go. Let's see. All right. What are common ways, steps to determine how much I have gained per account having set up a Sept and buying CDs for IRA purposes? Okay, so let me share my screen again and kind of write out the question. But I can go ahead and answer this. So this one I do know. And let me share my screen again. And waiting for my screen to share. Still waiting. And there we go. All right. So this question just came in. Second question. So we're looking at how to track gains and of CDs inside of an IRA. All right. So it sounds like this person has an IRA set up. Okay, so this person has an IRA. Now think of an IRA like a box. You can have a lot of different investments inside of this box. So you can have stocks, you can have bonds, you can have cash, you can have CDs, and depending on the type of IRA, you can even have things like real estate and other alternative investments. Fixed index annuities, a lot of times we see these inside of IRAs. So think of this as a box. And the important thing to understand is the value or the basis really doesn't matter, because whenever anything here comes out, it's taxed at your income tax rate. Okay. So when we're talking about IRAs, we're never really worried about like capital gains or what the basis was. So if you bought a stock for $100 and now it's $1,000, you don't have to worry about the gains or anything like that, or the tracking the basis, because the only time it's taxed is when you pull the money out. And it doesn't matter whether it's a stock or bond, a cash, CD, or fixed index annuity. It's always just going to be taxed. Whatever amount you take out, whether you take out 50,000 from a CD, 50,000 from a fixed index annuity, 50,000 from mutual funds. When you take that money out, it doesn't matter what the investment tool was, because it's coming outside of the IRA. Whatever that value is, let's say 50,000, it doesn't matter what the tool was. It's the amount coming out. That's going to be what's taxed. So what are the common steps to determine how much I have gained per account having set up the IRA? So if you're still trying to track, well, my CD grew from this to this, or this stock grew from this to this, that should all be handled by the custodian. You should be able to track that at the custodian level. For us, our main custodians, when we say custodian, when we're managing money, it's not like I'm physically holding the money or the money is at in our building. We use one of the big custodians out there, which are Fidelity. TD Ameritrade just got bought up by Schwab, so TD Ameritrade went away. So we have Fidelity, we have Schwab, and then we have another custodian that we use called Altruist, which is one of our favorite ones right now. But at the custodian level, they'll be able to track how much growth you've had on the different investments and accounts. But from a tax or like real world perspective, other than just trying to track how you're doing, it really doesn't matter. You don't need to track capital gains. So that's why, like, moving from stocks to a fixed index annuity or a CD, you can do that all with an IRA and there's no tax consequences, because the only tax consequence is when the money comes out of that IRA. Now, if it was like a brokerage account or a taxable account, then that would be different. Then yeah, if we cashed out, like let's say you bought Facebook for $100 and now it's at $10,000 and you sold it in a taxable account, you'd have to worry about capital gains. You'd have to know, okay, I bought it for 100, I'm selling it for 10. That's 990,000 or 900 or $9,900 worth of capital gains. That's going to show up as capital gains for your tax return. If you do it inside of the IRA, there's no tax consequence. It doesn't matter. The only time you're actually taxed is when you pull the money out of the IRA. So hopefully that was helpful. All right, a couple of questions coming in. How will we be affected if the government shuts down? To be honest, I don't really know. Plus, I don't think they always threaten a shutdown, but they hardly ever really shut down. So it's more of just a scare tactic. So I don't really have a great answer to that one. Is now a good time to cash out an I bond and roll it over to a CD? So, whoops. So I bonds were like the hot investment for a period of time. So I bonds versus what else? So I bonds were a hot investment because they're tied to what the government said the interest rate is. And for a period of time, I bonds were at about 9%. If you look historically, so this was at their peak, probably about a year ago. Historically, if you look at I bonds, just because inflation hasn't been that out of control, like historically, they're at 1 to 2%. Right now, and I'm just going off of memory, I think they're like at 4.3%. And they reset every 6 months. And you have to have it for a year. Technically, it's on a 5-year chassis, but if you cash it out before the 5 years, you just have to pay back like you have a penalty of 3 months worth of interest. So for a while there, we were recommending, hey, run out, get I bonds. You can put 10,000 in per person plus 10,000 for a trust. And at least for the next 6 months, you're going to be getting 9% on your money. And then it readjusts every 6 months. Well, it's been readjusted. So it was kind of adjusting up and we're like, oh, I bonds are the hottest thing in the world. And then now they're, even though I still say inflation's out of control, real world, like I looked to buy a hamburger and it's double what it was prior to the pandemic. But the government's saying that interest rates are coming, or inflation is coming back down. So with that, the value of those I bonds are coming back down. So I would not recommend purchase for most people. I would not recommend running out and getting I bonds. And in fact, I might be looking at cashing out those I bonds as well. So the question is, if you're not going to do an I bond, what are you going to do? Well, the big thing with the I bond is it's principal protected, meaning you're not going to lose that money, and you're going to get some amount of sort of guaranteed growth. The growth guarantee is for a period of 6 months. So if you're looking for principal and growth, and you're comfortable losing a little bit of liquidity, a CD could make sense. So a CD could make sense. Right now, like 6 month CDs are probably going over kind of 5%. We're looking at like short-term treasury bills. Still, you're in that kind of 4 to 5% range. We even right now have a high yield savings account that's completely liquid that's offering 5%. So that's where I look at the I bonds, which right now I think, and I could be mistaken, are about 4.25 or 4 and change. You're tying your money up. It's kind of a pain to deal with the treasury.gov website. So our big thing that we've been talking to clients about is really high yield savings accounts, treasury bills, CDs. If you're looking more long term, so all of these are like, if you're looking maybe like 1 to maybe 2 years at most. If you're looking longer term, like 2 to 5 years, this is where we're looking at multi-year guaranteed annuities. Same thing basically as a CD, but it's offered by an insurance company. And here we're getting, and this is a guaranteed rate. So even if interest rates drop, you're still looking at 5% plus. Then even longer term, we could look at things like fixed index annuities, which could be 5 to 10 years. And here, not necessarily guaranteed, but typically you're seeing rates of anywhere 5 to 8% over time. All of these are offering the principal protection. meaning you're not going to lose your money. Okay. Opportunity for growth. So if you have money sitting in cash, it's not even keeping up with inflation right now. And then the concern or the drawback of these is you have to typically sacrifice a little bit of liquidity. The only one that you don't have to sacrifice any liquidity on are the high yield savings accounts. So these are great cash accounts right now. You can find them online. Like we have one that right now is offering 5%. You can move money in, move money out, and there's no fees or anything. It's really just a value add for our friends and clients and family. Question here, how do we join your high yield savings account? Just shoot me an email at chris@castlewealthgroup.com requesting information on a high yield savings account. It's really nice. It's 3 steps. The first step is send you the invitation. You open up the account. Second step, you link one of your existing cash accounts to that account, like your checking or savings. And then third, you move whatever money in. And again, you can move the money out the next day. Pretty straightforward. There's no fees or anything like that. So if you do want information on that, feel free to just shoot us an email or reply to the Zoom email that you got. Also, the nice thing, it's FDIC insured. Our high yield savings accounts, FDIC insured up to, I think, $1 million, which is more than your typical savings account. But yeah, so I'm not a big fan of I-bonds these days. They kind of had their time in the sun. So I would be looking at one of these alternatives, just depending on your situation. And really short-term money, I really like that high yield savings account because it's completely liquid, it's flexible, you can move money in and out, there's no minimums or anything like that. So it's really nice tool depending on what your goal and strategy is. All right. Here's another one. Will turn 73 in January. Must I take my RMD? My birth date of that month is in April 2024. Yeah. So the year you turn whatever your RMD age, for a majority of people now it's 73. If you're younger, it's 75. You have to take it out either the year that you've turned 73 or you have April to take that first RMD. All right, that's all I got. If you do have questions, you want more information on the high yield savings account, feel free to just shoot us an email. Otherwise, make it a great week, and I'll see you next week, and hopefully we'll see